Preparing for a business audit can feel overwhelming, but with the right approach, it doesn't have to be stressful. An audit is more than a review of financial records. It's an opportunity to assess how well your systems, controls, and documentation support your business goals. When you take time to organize your records, understand common red flags, and communicate clearly with your auditor, the process becomes smoother, more efficient, and even beneficial. This guide walks you through the essential steps to take before the auditor arrives: how to identify and avoid common issues, how to keep your financial documents organized, and best practices for working effectively with your auditor, so you can approach the audit with confidence instead of pressure. Before the auditor arrives, start by reviewing and verifying all financial records. Go through your financial statements carefully and make sure every transaction is supported by proper documentation such as invoices, receipts, and bank statements. Identifying and correcting errors or inconsistencies early helps prevent unnecessary questions during the audit. Next, conduct a simple internal audit. Reviewing your records internally allows you to catch missing documents, incorrect entries, or unbalanced accounts before the official review begins. Fixing these issues ahead of time reduces delays and helps the audit process run more smoothly. Finally, prepare your team and workspace. Let your staff know the audit schedule and clearly define their roles. Assign specific individuals to handle document requests or questions, and set up a clean, organized workspace for the auditor with easy access to all necessary records and tools. Certain issues can quickly raise red flags during an audit. Unusual or unexplained transactions, especially those that are large, repetitive, or inconsistent, often attract closer scrutiny. Having clear explanations and proper supporting documents ready for these entries helps prevent unnecessary follow-up questions. Missing or incomplete documentation is another common trigger. Receipts, invoices, and proof of payment should always be properly filed and easy to access. When documents are missing or unclear, auditors may extend their review to investigate further. Inaccurate or inconsistent reporting can also cause concern. Differences between financial statements, tax filings, or prior year records may signal potential issues. Regular reconciliations and consistency checks help ensure accuracy and reduce the likelihood of triggering deeper audit reviews. Organizing your financial records starts with clear categorization and labeling. Sort documents by type, such as invoices, payroll records, tax filings, and expense reports, and use consistent naming systems so files are easy to locate and track when needed. Using digital tools can greatly improve efficiency. Storing records in a secure, cloud-based system allows for quick retrieval, reliable backups, and easy sharing with auditors, all while keeping your data organized and accessible. Maintaining confidentiality and security is essential. Sensitive financial information should only be accessible to authorized personnel. Protect both physical and digital records with proper permissions and security measures to ensure your data remains safe throughout the audit process. Working effectively with an auditor starts with transparency and cooperation. Provide requested documents promptly and be honest about any discrepancies you may have identified. Being open builds trust and helps the audit move forward efficiently. Clear and professional communication is equally important. Maintain open lines of communication throughout the process, and if any request or instruction is unclear, ask for clarification right away. This prevents misunderstandings and ensures expectations are aligned on both sides. After the audit is complete, take time to review the findings carefully. Address recommendations as soon as possible, correct any identified issues, and apply the lessons learned to improve your financial systems and controls. This proactive approach strengthens your practices and prepares you better for future audits.